As the U.S. markets are currently closed, Taiwan Semiconductor Manufacturing Co. Limited, ticker TSM, closed the last trading session on Friday, October 10, 2025, at $175.15, down $2.30, a drop of 1.29% for the day. Now, a single day's movement of just over 1% might seem like noise for a titan of this scale, but the expectation that TSM is simply a bulletproof behemoth misses a much more fragile reality hiding just beneath the surface. The number everyone watches is its technological lead, its grip on the world's most advanced chips. The reality investors are now forced to confront is that the stock's price is becoming less about its next-generation 2-nanometer node and more about a geopolitical chess match where TSMC is the board itself. The entire edifice of modern technology, from the iPhone in your pocket to the servers powering artificial intelligence, rests on this one company, located on one island. That concentration of power is both its greatest strength and a vulnerability of staggering proportions. The common belief, the one you'll see repeated across countless forums and financial news segments, is that you simply can't bet against TSMC. It's the ultimate picks and shovels play for the entire digital age. If you believe in the future of AI, high-performance computing, or smarter devices, you have to believe in the company that manufactures the silicon brains for them all. That's the expectation. But let's challenge that. Is it possible that TSMC's dominance has become so absolute that it is now a single point of failure, not just for the global economy, but for your portfolio? The market is starting to price in this risk, and the subtle oscillations in its stock price, the intraday swings we saw last week, are the tremors before a potential quake. The stock didn't just drift down on Friday. It was part of a pattern of heightened volatility that has characterized the semiconductor sector all year. Trading volumes on down days have been noticeably heavier than on up days, suggesting that conviction among sellers is currently stronger than that of buyers. This isn't panic, but it's a clear sign of institutional hedging and risk-off positioning. Large asset managers, the kind that use sophisticated platforms from Interactive Brokers or have their wealth managed by services like Fidelity Wealth Management, are not dumping their shares wholesale. Instead, they're trimming positions and buying protection, a defensive maneuver that speaks volumes about their forward-looking concerns. The reality is that the professionals are treating TSMC less like a growth stock and more like a geopolitical asset with a tech component. Let's look at the recent performance in context. The last earnings report was, on the surface, solid. The company beat estimates on both revenue and earnings per share, and its guidance for the upcoming quarter was in line with expectations. But the stock barely moved. Why? Because the market's expectation was for a blowout quarter fueled by unrelenting AI demand from clients like NVIDIA. When reality simply met expectations instead of shattering them, it was seen as a quiet failure. The conference call was dominated by questions not about gross margins or capital expenditures, but about contingency plans, supply chain diversification, and the status of its new fabrication plants in Arizona and Japan. The CEO's carefully worded answers did little to soothe nerves. The market heard the unspoken truth. Diversifying a manufacturing process that takes decades and hundreds of billions to perfect is not a simple task. Building a fab in Arizona doesn't replicate the unparalleled ecosystem of suppliers, engineers, and logistical efficiency that exists in Taiwan. So, while it's a necessary step, it's also a deeply inefficient and costly one that will weigh on margins for years to come. This is a critical detail that many doing their self-investing on apps like Robinhood might overlook, focusing only on the headline revenue figures. The performance of Apple stock and NVIDIA stock are inextricably linked to TSMC, and any hiccup in TSMC's production capabilities sends shockwaves that affect countless Fidelity ETFs and Fidelity mutual funds focused on the tech sector. For those less familiar with the company's core business, TSMC operates on a simple but powerful model. It's a pure-play foundry. This means it doesn't design its own branded chips like Intel or Samsung traditionally have. Instead, it offers its world-leading manufacturing services to any company that designs chips. Its clients are a who's who of the tech industry: Apple for its iPhones and Macs, NVIDIA for its AI GPUs, AMD for its CPUs and server chips, and Qualcomm for its mobile processors. This model allowed TSMC to focus all its resources on one thing: perfecting the art of semiconductor manufacturing at the most advanced levels, what are called process nodes. They have consistently been years ahead of competitors in shrinking the transistors on a chip, moving from 7 nanometers to 5 nanometers, and now to 3 nanometers and developing 2 nanometer technology. Each step down in size allows for chips that are faster, more powerful, and more energy efficient. This technological supremacy is the foundation of its moat, and the reason why for the most advanced chips there is often no alternative. This is why when you check your SoFi Invest account and see the tech sector moving, the undercurrent is almost always tied back to TSMC's health and output. It's a foundational piece of any serious online investment strategy in technology. For those less familiar with the company's core business, TSMC operates on a simple but powerful model. It's a pure-play foundry. This means it doesn't design its own branded chips like Intel or Samsung traditionally have. Instead, it offers its world-leading manufacturing services to any company that designs chips. Its clients are a who's who of the tech industry: Apple for its iPhones and Macs, NVIDIA for its AI GPUs, AMD for its CPUs and server chips, and Qualcomm for its mobile processors. This model allowed TSMC to focus all its resources on one thing: perfecting the art of semiconductor manufacturing at the most advanced levels, what are called process nodes. They have consistently been years ahead of competitors in shrinking the transistors on a chip, moving from 7 nanometers to 5 nanometers, and now to 3 nanometers and developing 2 nanometer technology. Each step down in size allows for chips that are faster, more powerful, and more energy efficient. This technological supremacy is the foundation of its moat, and the reason why for the most advanced chips there is often no alternative. This is why when you check your SoFi Invest account and see the tech sector moving, the undercurrent is almost always tied back to TSMC's health and output. It's a foundational piece of any serious online investment strategy in technology. The future outlook for TSMC presents a stark contrast between expectation and reality. The expectation is a clear path to continued growth. The AI boom is still in its early innings. The demand for sophisticated chips to train and run large language models is exploding. The automotive industry is transforming, requiring exponentially more silicon per vehicle. The Internet of Things will eventually connect trillions of devices, all needing some form of intelligent chip. This is the bull case in a nutshell, and it's a powerful one. It's the narrative that supports the idea that TSMC will continue to compound returns for those holding it in their individual brokerage accounts or through automated services like Schwab Intelligent Portfolios. The opportunity is immense, and TSMC is at the center of it all. This is what drives many retail traders on the Robinhood app to buy into the story, sometimes using Robinhood fractional shares to get a piece of the high-priced stock. Now, let's turn to the far more sobering reality. The risks are no longer abstract long-term concerns. They are clear and present dangers. The primary risk, of course, is geopolitical. The escalating tension between the United States and China over Taiwan puts the company in an impossible position. Any military conflict would be catastrophic, instantly halting the global supply of advanced semiconductors and plunging the world into a severe economic depression. This is not hyperbole. It is the assessment of governments and economists worldwide. This single risk factor should give any investor a pause. Beyond that existential threat, there are significant other headwinds. The semiconductor industry is notoriously cyclical. While AI is providing a strong tailwind now, other segments like smartphones and PCs are seeing slowing demand. A global recession could significantly dampen overall demand, leading to fab overcapacity and pressure on pricing. Furthermore, the cost of staying at the cutting edge is astronomical. TSMC's capital expenditure budget is tens of billions of dollars per year. This is a massive financial burden that requires flawless execution and consistently high demand to justify. Finally, competition is waking up. Intel, under new leadership, is aggressively investing in its own foundry services, IFS, with heavy backing from the U.S. government's CHIPS Act. Samsung is also a formidable competitor, constantly trying to close the technology gap. While TSMC has a significant lead today, it is not unassailable. Comment below with your thoughts on the biggest risk facing TSMC. Is it geopolitical tension or cyclical semiconductor